Welcome to Richard Suttmeier's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. My first blip looks at the strong dollar, the result of economic weakness spreading around the world. The daily chart for the dollar versus Japanese yen shows an overbought condition with weekly support at 107.19 and quarterly resistance at 111.45. The daily chart for the euro shows an oversold condition after failing above 160 on July 15th, repeating a similar fate on April 22nd. The euro followed gold lower, below its 200-day simple moving average at 1.5227 on Friday. The euro should return to my semi-annual pivot at 1.5161. The daily chart for the British pound also shows an oversold condition after being above my semi-annual pivot at 2.0071 on July 15th. Cable is trading around my annual pivot at 1.9217 this morning. My second blip shows the weakening trends for COMEX gold and NYMEX crude oil. The daily chart for gold shows an oversold condition after peaking at 989.6 on July 15th. Gold has been below its 200-day simple moving average at 890.6 since July 5th. Semi-annual support is 796.5. The daily chart for oil is also oversold after peaking at 147.27 on July 11th. The conflict between Russia and Georgia has not had a big impact this morning, but there is a modest recovery to just above 116 per barrel. The 200-day simple moving average is 109.76, with this week's resistance at 125.51. There may be reduced demand for energy on the global economic slowdown, but in my opinion, the major reason for significant downside volatility in crude oil is reduced investments by pension funds. Pension funds' investments in the commodity asset class peaked at about $300 billion at the end of June, and liquidations have probably exceeded $30 billion since then. I say investment demand by pension funds caused the gasoline to spike above $4 per gallon a few weeks back, not normal supply and demand consideration. I filled up at $3.59 a gallon in New Jersey on Saturday. My third blip looks at monthly, weekly, and daily charts for the Dow Industrial Average. The Dow remains above its 120-month simple moving average at 10,601. A monthly close below 10,601 signals a multi-year bear market. A week ago, I said that this event would not happen in August. The weekly chart shifted to positive on Friday with a close just above the 200-week simple moving average at 11,714. The daily chart shows the pattern of lower lows and lower highs, but daily closes above the 50-day simple moving average at 11,679, targets the 200-day at 12,512. My fourth blip questions how long the markets can ignore negative news from Fannie and Freddie. The stresses in the credit markets go beyond the scope of the late 1980s, early 1990s. The contagion in the great credit crunch of today has spread rapidly from mortgages to exotic bonds to student and corporate lending to credit cards, home equity loans, to residential and commercial real estate. Fannie and Freddie own or guarantee nearly half of the U.S. mortgage market. The housing bill puts taxpayers' money on the hook if the U.S. Treasury uses its blank check to support these GSEs. Over the weekend, Treasury Secretary Hank Paulson reiterated they have no plans to use this new power, which in my opinion would implement a de facto nationalization of Fannie and Freddie. This morning I read that John Hancock Classic Value Fund is down 42% in the past year as of July 15th. They bought Fannie and Freddie as their most undervalued stocks in their universe. If you have any comments or questions, shoot me an email, gmcreports@aol.com. That's today's 4 in 4. Enjoy your day.